why if China and India are far more populated, there are not much interest on investing in their local companies? I think these questions, right, it's not just China and India. This is also true for, countries like Singapore, Malaysia. I think there's also not much interest in investing locally. I think one speculation is that I think all these countries, if you look at their stock market, maybe with the exception of India, like if you look at Malaysia, you look at Singapore, the local stock market also not doing that well, right? So I think that could be one reason. There might be other reasons. So I'm just curious to hear your thought on this.
For me, I would think that it is kind of a country by country basis. Let's say we talk about India, for example. Let's say if we are businessmen, right, and we go to India to start a business, the things that we will be looking at, of course, would be that, yes, we know that there's a high, okay, so yes, we know that there's many people there to sell to, the huge market and everything. But then we start to look into like the starting of the business, what are the hurdles and red tapes we have to clear. From there itself, of course, we can look at the laws and regulations on a city by city or state by state basis in India. But then we can also look at the past examples of companies that are high profile, right, and public listed that went to India. And we'll see that one of the more recent examples would be like Shopee itself. They go to India and they try to create up that gaming division and try to have a foothold inside there, right? But you kind of see what happened over there. So for those who don't know, the kind of like the politicians over there kind of say that, oh, Shopee has like is intruding into their markets and things, and then all kinds of regulation comes up, and then Shopee kind of is like not that into India anymore. So you can kind of see these are the kind of things that happen when you go to India to do things. Then, of course, you can also look at like DBS itself. They try to go into India. And then even right now, instead of like proliferating to the whole of India's markets, they are kind of restricted to a few places only. So even for DBS itself, despite India having like influence in Singapore, Singapore only has like influence in like very small parts of India, right? Because the India government, right, or the India climate is that they are very protectionist and they want to protect whatever that it is that their own people can do. So if we are going to India on like a wholesaler or kind of like non-disruptive technologies kind of way to go in, right? You see that it more or less, because the locals think that they can do it better than you, then they will try to include some kind of restrictions or things that makes it harder for your company to compete in there. And then eventually their own local supplier or things will their local business will take over whatever segment it is. So that's their way of doing business. So when we look at it from this perspective, is it really that good to go start the business over there? Because unless you are providing something that is like truly disruptive that the India local people cannot do up, right? Otherwise, they more or less will try to take over. Yeah, that's the kind of feeling I get when I look at like going to India to start a business. So I think there are many more examples, and of course, some parts of what I say may not be 100% true, but that's the feeling that I get when I look at India. For China, it's also kind of similar, but not to that level of extent. But for China, it's kind of like it's not for the difference between India and China is that India they try to get their politicians or government regulators to do something about it. For the China side, it's more of like is the kind of like the other way around, whereby whatever you go there to do, there will be a Chinese competitor that sees what you're doing, understands your business model very quickly, and then copies it and then does it better than you. So there is that kind of level. So the competition in China is way more intense for things that they can actually take over. And they will have, their locals will actually like very quickly catch on to your idea and take over. Again, once if it's not some kind of disruptive tech that they have no access to. So for China, that is the case. And then let's say for the other countries, like what else is there? There's like Middle East. Middle East is kind of you don't know whether Middle East is hard to calculate like how long your business will last there due to like all kinds of uncertainty. The same goes for the other poorer countries, which is like the ones in South Africa, and then also South America and Latin America wise, these are potentials because they kind of I'm not that familiar with them there over, but I've seen that businesses go there and they do somewhat okay lah. So yeah, so just kind of just looking at that perspective, this is how they are. These countries that the general feel and mood of to investors is that level. So
Yep.
once we have that level of thinking, right, then we think so the businesses that are private equity go over there and they face this kind of issues. What about the public equity? They are more like high profile and needs more transparency. It's even harder for them to go over there because if the private equity is finding it hard, then the public equity is going to find it even harder.
Yep.
That's my feeling.
Yeah, but it's quite interesting because I read these questions. I thought like the person asking is interested to see, okay, do you want to invest in companies that's already operating, like the local companies? Say, for example, in China, you have all the big banks, right? They are quite huge. And then aside from the financial, there's still many industries, right? That I think maybe for China, or both India as well. Sometimes there's some restriction. It's not so easy for us from the outside to invest directly, right? But it's not impossible, right? But just now what you answer is mostly you are talking about like companies or individuals setting up either small business in local market. But what about like investing in established market? Say for example, India, they also have Adani. They have to also have their conglomerate. Is it because we lack familiarity with the market? We don't know how they operate, so we're staying away, or is it like the reason that you think people should not put their money into these local companies?
Yeah, I think that's mainly is about the familiarity, though, because Singapore is more of like a Western style of like accounting, right? So
Yep.
the Chinese style of accounting and the India style of accounting is not that similar, and they follow some of their rules are different for accounting things, right? So it is not that transparent. Yeah. So if you are comfortable or you are familiar with the markets over there, you think that it's that kind of opportunity, then this would be the perfect time to go in there to invest. But again, take note that when investing in these, not in the mainstream, not in the Western mainstream news companies, right? The attention level is far lesser. So you have, in a sense, there will be less hype and momentum. But it is also good because it means that you can focus more on the fundamentals, on the cash flow, and on like the profit margins and returns to the equity side. And if they are actually return solidly, right? And and it's also reflected, and if it's reflected in the equity prices, then that's a good thing. But if it's not reflected in the equity prices, then you have to look more at the dividend side, because if the company is not giving any dividends and the equity is not moving up, even though it's posting very good financials, you'll not see the returns that quickly until like some catalyst makes people push in the attention to it and then rise it. So it's actually entirely possible for like some of the companies over there to have like good fundamentals, good returns, poor dividends, and even though everything on the balance sheet and cash flow looks nice, right? But the price is actually very low. So that's what you see when you see that the PE ratio is very, very low, or like even the PB ratio is very low as well. Yeah.
Yep. Actually, I have one more thing to add. Although we often talk about US companies, right, or the big tech, or even smaller companies, and sometimes when we talk about China companies, we talk about like companies like Tencent, Alibaba. Actually, although these companies are located or headquartered in US or in China, but one common one similarities is that actually we are familiar with the products or services provided by these companies, right? Say for example, we are all using Google, we are all like buying Apple products. So although they are US based, it's not just because okay US is good or China is good, right? It's because we we use their products. That's why there's this familiarity with the services, product and services. So it's not about they are not coming from China, not coming from India, and so on. So if let's say that there's one company that produce product or services that's great, and we love it, and they just happen to be coming from India, I don't think that's a big reason to say, oh, because of India, so we're staying away, right? Mostly, I think the first one is still the understanding on the product and services first. I think that's the one last thing to add. Okay, let's move on. There's still quite a number of questions to go through. I'll come back to this if I have time. I just want to go through other questions first. Let's go through this one. It is far better to buy a wonderful company at a fair price than fair company at a wonderful price. Can share what's your opinion criteria of wonderful companies? YCX, you go first on this.
Wonderful companies are companies where, I mean, it's very broad. To me, wonderful company is a company which I think I can see that the management is good in, they are very sharp in reacting to shifts in technologies or shifts in the trends of the business world. So like if they see that there's a trend shift to AI, they actually quickly catch on and jump onto it and pivot to actually capture the market share quickly. So that is like first criteria for wonderful company will be the management. And second criteria will of course be the existing business. What exactly is it doing? Does it have any like is it a scalable kind of company, or is it like sunset industry? So sunset industry can also be good, but then if it's sunset industry, then the emphasis more will be on like what are the returns that it can providing. For something that is like a sunrise industry, then that would be ideal because there's many ways to expand or go into. Yeah, so those are like the two key things. So the thing over here is that I don't touch at all about the price, because price is kind of like what I would only look at the very end. So I don't look at like price history. I don't look at I just look at the company, what is it doing first, and what does its balance sheet say, and what's its business model, and what does its leaders say, and then also what is the public feedback, or what is customers' feedback on what this company does, how are they providing value to them from a qualitative perspective first, before we talk about like the quantitative perspective.
Yep.
So after that, once we determine all the qualities of the company already, that would form the basis of what I think whether it's a wonderful company or not. Then when it comes to whether it's a fair price or not, that would actually depends on relative to the rest of my portfolio, whether it's something that I think I would want to allocate a lot of my money to it or less of my money to it. That's the way I look at it, from whether to look at something at fair price or not. Because to me, fair price is more of a portfolio allocation thing, because it has to be compared relative to either the other companies in that sector or industry, or it has to be compared to the rest of my portfolio holdings.
I think on this price or valuation part, I 100% agree with you. I noticed that too many people, the first thing they look at is quantitative, and then if the quantitative doesn't fit their criteria, they just move on to the next company, and they don't even spend enough time to study the qualitative part. And the hard part about the quantitative is not like DCF is hard. It's actually very easy to do. The hard part is actually it is something that's keep moving. Like after 1 year, a company that's overvalued can become cheaply valued, right? All these things keep constantly changing, and even the fundamentals also sometimes can change very fast, right? So if you keep on monitoring the valuation part, right, and don't in terms of the time spent to put too much on the valuation, then day in day out it's only doing valuation here and there, and don't spend enough time to understand the qualitative part now. And the qualitative part, what I like it the most is that it is usually quite stable. Like the business model, whether there's business model there or not, and the quality good or bad, right? Actually, this one usually it doesn't change that often. Maybe some industry is moving faster than the others. For example, like those high tech ones, sometimes you get disrupted. But even so, the disruption doesn't come in like 3-6 months time. So it usually comes in years, right? So if we spend long enough time to monitor the qualitative part, it's actually much more dependable as compared to quantitative part. Of course, that doesn't mean that companies that have good quality is a buy at any price, right? I'm not saying that. It's just that if we spend more time on the qualitative part, actually we learn a lot more as compared to a DCF, right? So I think that 100% agree with you.
Yeah,
And
so the kind of, if you want to just base on like fair prices to buy, I'm sure there are many. You just search for like those low valuation on like the Google search or something, and then there's many sites that just print out the entire whole list of like low valuation. That means like the so-called good balance sheet kind of like companies out there that you can just buy, or there's an ETF that's actually monitoring those, and you can just buy, and then there's no need to actually do much work either, or you can just do that. Or so that is like, if you there's always an ETF for any single thing that is well established, or whether it's by fair prices or by like whatever is of a certain thematic industry kind of things. So
factor ETF lah. Yeah, these are already commoditized, so you don't even have to do it yourself, right? So if you are going to do single stock analysis, it's better to spend on things that is not commoditized yet, like those factor ETF. Is really doesn't make sense to do it on the individual companies level. You need some sort of algorithm, some sort of filter rules, and then basically just buy on index is better. Okay. Yeah. I think I just want have one more thing to add on this. Like what YCX shared, right? Talking about like companies, whether it's sunset or not. I think that one is also one of my criteria. And aside from that, actually, I spend quite a fair bit of time to understand the culture of the companies. For example, if we want to identify companies that is leading in their industry, right? I think companies that is leading currently have the higher tendency to continue to lead. Say, for example, like let's say in smartphone market, right? You notice that usually Apple, although in terms of volume, they are not the biggest volume, but the company, right, Apple, they tend to lead other companies. Say, for example, they are the one that say, okay, we are going to take out the charging brick from the smartphones, right? So they do it first, other companies laugh at them, and then they follow. They take out the headphone jack, then people, other companies laugh at it, and then they also follow. So, and then, for example, talking about this transition to ARM PC, right? Apple is the one that do it. Then now we see that other companies, say, for example, Qualcomm, even Nvidia also want to join this space, right? ARM Windows PC, right? So you can see that companies like Apple, they tend to lead because they have some insights and they have the discipline and execution power to pull it off, right? So I believe that companies like this, right, they really spend a lot of their time not at chasing other companies, but to spot where are the trends and then just be the leader, right? So I think that I'll pay a lot of attention to this kind of like small things now, because I think that these are the companies that know where to look for opportunities. Like for example, AI, which companies that are moving fast, right? You can just monitor. So usually companies that is moving fast, they have first mover advantage. And then when it comes to executions, you see that they are also leading. So these are the companies that I think have more potential. All right, let's move on to the next questions. We see many companies in the US off their high. Is this what you see when the market is in bubble prior to crash, based on past experience prior to crash? I think this one we mentioned it. I think we briefly touched on it last week, because yes, market crash from time to time, but the difficult part is also that it is unpredictable, right? And anything to add on this, YCX?
No, I think it's just not possible to predict crashes accurately. And even if you can, shorting the market has negative interest that you have to pay. You can't just hold on to your short position all the time. So timing crashes is more luck than skill. That's
Yep.
what I can say. Because even if you have the skill to know that really there will be a crash coming, right? But you don't know when it will trigger. So sometimes, yes, you are at the point whereby you think that the crash, maybe you think you are 99% certain there's a crash, but the crash can come like 1-2 years later. And are you willing to hold on to your short positions for like 1-2 years? That's another thing altogether.
Maybe not short now. What about people who like save, 80 or 90% in cash or in, let's say, T-bill or in some, like UOB account earning 4 or 5% interest? What would you tell this group of savers?
I mean, yeah, it's kind of like what's your perspective on again, this is about the anchor point of your investment perspective, right? So if let's say your anchor point is that the base minimum is the 4 or 5% that you're getting from fixed income kind of instruments, then of course then that will be valid. But if let's say your base perspective is like say higher, like maybe it's the equity risk premium, maybe you value it at like 9% or 10% equity risk premium, then that will be the 10% number. So if you're putting it into fixed income at 5%, while your equity risk premium is at 10%, that means you are kind of also shorting the market in the sense that because you're not in it. So it depends on what's your anchor point. If it can't be that your anchor point is zero, right? So it's either whatever fixed income rate that you're getting, or it's like the equity risk premium, or it's some company that you anchor to. Yeah, that's about it.
Yes, agree. I think when it comes to holding cash, right? I can share a bit. Like for now, I also have some cash because I do agree that when we look at all these valuations, right? It's true that I mean objectively assessing the market, you look at PE, you look at all these different indicators, buffer indicator, whatever it is, right? It does seems that the market is overvalued now. I'm not saying it is bubble. Bubble is where people just like don't look at the price, keep on buying, and everyone is like upgrading their cars, their house, right? So everyone what big that one is really bubble. Right now, I would say it is overvalued, but not bubble. And so if you look at the market and you say you want to hold some cash, I think that's perfectly reasonable. I personally also is not 100% invested in stock market. I also have some TBU, some cash here and there. But I would say this, right, to those who have like, over allocated into cash. Now it seems good because, like buying TBU, you have like close to 4%, putting in UOB, maybe it's like 4%. Maybe some other fixed income funds you can get, let's say 5%, right? So those are decent yield. The problem is always that what happened after 6 months and 12 months, right? Let's say if T-bill come down 1%, or maybe even 2%, right? What do you do, right? If you're holding too much cash and then market just continue to go up, and then the painful time comes when the interest rate drop, which happened to UOB account one, by the way. So then you will have a problem because it will create a huge cash drag to your performance, right? So this one definitely is like the risk that you're taking instead of like the risk of buying at high now become the risk of cash drag in the future, right? So the reinvestment yield that you need to pay attention to. I would say that one definitely is not small. Let's say if you have like 20% in cash, I don't think that's a big issue because you still have, let's say, 70 or 80% invested, right? I would say you need to look at your allocations. If you have too much, by too much, I mean, let's say above 70% into fixed income or cash equivalent, right? This is something that is quite big. Every 1% or 2% of cash drag, you just multiply, you can see that it's really quite costly. And once you start on that path, right, there's high tendency you will continue to start because you are not willing to buy into the market now. Let's say 1 year later, market is 10% higher. It's harder to buy into it. So that one, just pay attention. So I think the key point of all this is to have a balanced portfolio.
Actually, for me, you are right on that. You touch on that, right? So the key issue over here is that we shouldn't be looking at like just the prices of like the stocks and things. Because to me, I find that just looking at prices and just looking at prices is not really that effective. Because if we don't look at the price, we just look at say the PEs, right? Let's just look at PEs and also maybe forward PEs. We will kind of see that the increase isn't that high. Just if you just look at like the PE increase of like the SP 500, yeah. So then price itself is a people think that price is absolute, but it's actually subjective because you have to do a DCF model on the cash that you're holding as well. If you get what I'm saying, because if you say that everything you do DCF model, then the cash also has to do a DCF model, right? And the DCF model has to be depending on what numbers you want to use lah. So could be interest rate, could be inflation rate, could be whatever things. So the other key thing over here is that the idea that I would like to hold is that one person should never have their entire portfolio at the very like extreme end of either side, whether it's like majority cash or majority stocks. Because at any point in time, I find that the market is always kind of like in the middle, as it's unlikely to be like high. The tendency of it to be in like high bubble zone or like in high recessionary crash zone is usually very fleeting. It's maybe like in 10 years, maybe that zone is more like in that 2-3 months, it either hits that zone or it hits the other zone on the extreme end. So why should your portfolio be geared for either extremes, right? So it should kind of be like in the middle, whereby you're holding some amount of this and some amount of that. And yes, if there is a crash, your portfolio will definitely be affected. And there's a bubble, the portfolio likewise will all be inflated up. So the point is that once you hit that crash zone, right, when everybody is afraid, then you can kind of think, okay, it really does seem like everyone is in such a down state. This would be the right time for me to actually invest in the market, because that's when blood is on the streets. So you can just buy whatever you want at whatever that you buy looks bad, because everything looks bad. So that's the best point to buy everything. Then in the bubble zone, everything looks good. Then that will be the best time to sell whatever that you hold and trim it down. So take the middle path and allocate. Don't push yourself into either corner whereby you are full cash or like full allocated, that kind of things. It's not good because the tendency of you to be in either positions for a very long term would just lead to bad decisions, because you develop this fear of missing out feeling. So for that, and of course the other thing is that holding a lot of cash, we also have to kind of think of it the reverse way, right? Which is that if we allocate a lot to bonds, and let's say the bonds are paying good now, paying maybe 4-5%, and then later on when the bonds drop to like, say, if let's say there's a drop to like 2-3%, and we find that it's not attractive, right? But we will think that, okay, maybe now is the time we should look at buying some stocks or buying something like that. And the feeling over here will be that you have to understand that the stock market is 6 months early. So by the time you feel this, all the prices will have risen to the point whereby you might not find things that you want to buy attractive at that point.
Basically stuck. And just by the way, the father of value investing, Benjamin Graham, right? In his book, he also say that by equity allocations, right, you shouldn't be outside of the range between 25% to 75%. So basically, he's saying the same thing, right? Don't push yourself to zero. Don't push yourself close to 100%. It should be somewhere between 25 to 75%, because you never know, right? Because although it looks expensive now, it can continue to go up further. And if continue to go up further while the fundamentals stuck, still can say that, oh, now we are forming a bubble. But usually what happens is that even the earnings, the economy, everything go up together. So although it can go up another 25% from now, and yet the valuation still, reasonable, because everything grow, right? So I think that's the situations. Don't push yourself to extremes. Okay, let's move on to the other questions. I think I will skip all this first, asking about like staying in Malaysia one. Okay, I think this one we go through already, talking about the R&D. Okay, here are the questions for YCX. YCX can advise if you want to check a brand's increasing or decreasing acceptance, what or where you check, like McDonald's.
I think this one we went through as well. I recall
talking about brand, no?
Yeah, I showed like the Google Trends search and everything the last session. So that's where, and then for for tech stocks, I would say look at Hacker News, Reddit, Twitter, all these things for what the feedback is, and
Yeah.
also can also look at GitHub for tech things. For more of like fashion brands, this would you have to ask people in the fashion industry what do they usually monitor or who do they look, and I suspect that there's also a look towards like what the fashion icons are wearing or keeping up with. So it's another segment of news that kind of we have to look at or see what they are following and trend. Like, it's not my area of specialty, but I would kind of think that that would be where I look at if I would be buying this kind of specialty. As for like McDonald's itself, right? Fast food, generally, I think fast food is a very homogeneous industry. They all provide roughly the same thing. So when one goes up, the rest more or less goes up, unless they have like their models of business operation is not very complex. It's all usually the same. It's like they run a retail store, and then they have like all kinds of promotions or margins that we can look at. Is more or less similar because it's a very how do I put it? It's a monopolistic competition field. So the prices of chicken are the same for everyone. The prices of beef are the same for everyone. It's just how these companies package their beef, chicken, or whatever offerings into different products and then offer out. And then the rest is all about their margins of operations, which are more or less fixed because they are retail food companies. For McDonald's, the other main segment of its company is that it's also a real estate company. So for that part, you have to go into the real estate to look at it, because McDonald's fortunes are more or less tied to real estate more so than its retail business right now, which is more, its retail business is more of like a consistent cash generator for it, while it tries to do more on its real estate portion. Yeah. As for like Lulu is more of a fashion kind of thing. Nike is also a fashion kind of thing, which I touched upon just now.
Yep.
Disney itself is it's an IP company, and we have to look at how it monetizes its IP. So for now, its segments are more there isn't any new segments that is actually going into. So it's all about the execution right now, until there is like some kind of ways that it can invent a new segment for its intellectual property, because Disney is sitting on a huge ton of intellectual property that is just trying to figure out what is the best way to monetize them. So it's not that they have nothing to monetize, it's that they are trying to find out what is the best way to monetize it for longevity. That means for long-term kind of thing, and to monetize it for like short-term the cash rate that they can get. Because they basically they have to put their effort in the right places to monetize and not to destroy their brands across time. So let's say if I were looking at Disney, I would try to look for like, are there any segments that they can go into that will create new markets? That's the most important thing that I would look for Disney. And mostly Disney, the other issue that I find with it is that it is very closed in terms of like the brands are not easily monetized by the user generated content. That means most of the content itself is more of like company generated instead of user generated. So in that aspect, that would be the most key thing that I look for Disney to break through. If it can monetize user generated content on its existing brand, it can actually build on its brand and make it bigger. If not, then its brand is going to be marginalized, because the current trend right now for youngsters is that they like to generate their own content or use content in ways that fit their own character or prove a certain point. And Disney likes to lock down on these forms of expression, which is not good for it.
This is where I talk about the culture things, right? I think this is really in their DNA. In fact, their DNA is quite similar to Apple. They don't like all these outsiders to go and like play around with their IP, right? So they just want to close down, and then they want to hire the best designer and do their own thing. and just like be a closed system. So I think this is in their DNA. I don't think it's fair to expect them to change their DNA, because all these companies, it is who they are. Like they can't change, right? So that's my feel when it comes to on this angle. But it's okay. I think it's just that I think the hardest part is still the executions part. If they can execute well, it's still there's tons of opportunity. It's just that I think they're also facing a lot of competitions in terms of their like Disney Plus, and also I think there are challenges everywhere. That's okay. I think the second one, this one also we covered. So
I'll just give like a quick overview. Like the two main points of it would be that one is the Nvidia wants to get recurring revenue in the form of like software. So they want to actually sell their enterprise software and sell their omniverse software, and their the three main things would be their enterprise, AI enterprise software. Then their second thing would be their omniverse, and third thing would be their Nvidia Drive software. So these are the three, and of course there's a fourth one, which is the GeForce Now. These are the four main segments of like software recurring revenue that Nvidia is trying to move into. And so far, I wouldn't say that they are executing badly. It's just that relative to how much hardware that they sell, is actually their software revenue is not increasing at the same exponential rate. So there is that execution risk whereby they as a company, they could be doing completely well and fine, but at some point, perhaps they may reach a tipping point whereby there is a slowdown in hardware sales on the data center side, and the software revenues have not risen up to catch up to that, to make up for that slowdown in data center revenue, hardware revenue sales. So that will be the point whereby we can expect a correction in terms of like the price of Nvidia towards the downside. But it's also kind of at that point in stage will be like another inflection point where we see if we think where Nvidia software side can actually make up for it, and over time it actually grows and they become a more full stack solution provider and solution seller. And of course, it's also a inflection point for the cyclical, because as we know, hardware itself is kind of cyclical. When there's always a boom and a bust, and that's for that side based on existing markets. There's also the other side which we had to look at, which is that countries itself are now thinking that they might actually want to set up their own data centers and buy their own hardware and keep their own data in their own country no matter what. So for that to happen, they would need to have their own hardware. So Nvidia is right now at this point where it's trying to push and maintain its revenue growth trajectory through higher company sales, tapping on higher company sales, and also tapping on sovereign state sales. And then at another point is that there will be a point whereby these people have enough of these sales, right, and slow down their purchases, because it becomes like a renewal rate thing. It's just that we are not sure when this particular time will come, because based on the results and based on like the forecast of everyone, is that even the B100, B300s are now all going to be sold out the moment that they are, the moment that they are available, because Nvidia is already doing pre-sales 6 months ahead of its launch. So these companies are already allocated some amount of B100s, and they are right now it's just a matter of whether they can fulfill the delivery. It's not even whether they can sell out, because they are already sold out. It's how far ahead that they want to do the sales and then fulfill the delivery for Nvidia right now. So the prices that we see Nvidia is right now, right, is actually already 6 months ahead where we are looking at that. So all the analysts right now, and even the price right now is reflecting that 6 months ahead. And every time there's a new earnings report, is actually everyone is more focused on what is the future, what's going to happen in 2025, maybe the early 2025 and mid of 2025 and late of 2025 accordingly, because everyone is certain that the sales from now until the end of the year is definitely all fully sold. That's the situation right now.
Yeah, I think follow-up question on this is that where do you get data to view analyst forecasted revenue and EPS for the company you are monitoring? This one I definitely I saw like in terms of the average analyst forecast, right? For Nvidia, it's true that over the past 3 or 6 months, you can see the price keep going up, right? At the same time, all these analysts, they are revising their forecast also. Where do you monitor this, and do you pay much focus on this?
Because I try not to look at it. I try to actually do my own one first before I look at theirs. Because I think it's kind of like a acquired skill, and also kind of like to see where your own bias is compared to the rest of the analysts bias are. So I would do my own one first before I look at what's on like Yahoo Finance. Under Yahoo Finance, you can just press like the analysis tab on like Nvidia, and then over there it will show like all the analysis like high, low, and average.
Yep.
There are many platforms where you can see that. I think almost everything can see finance charts, bar charts, market trends, or whatever. All the sites all have like some aggregate of like all the analysis, all the analysts, and they put there. But important thing to note is that all these are all sell side. So sell side means that they are trying to put they are all working for the brokers or exchanges or banks, right? The bank's broker side to actually like give this kind of information so that people who use those platforms find that their information is useful or timely, and then they will continue using their platforms and things. So the analysts always have a bias towards like being slightly positive, no matter what. That's my view on like all these analyses. So for me, I would suggest that it's best that we do our own forecasted revenue and EPS. And then after doing our own, like we do it every quarter, like after the earnings report and things, we do it every quarter based on what they say, or what the earnings transcript says, and based on what we listen to, and also based on what their current data and company forecasted revenue and things are. And then for me, I would do like a worst case scenario, most likely case scenario, and a very optimistic case scenario. After I do out these three, then I compare with what's on the websites, or what's their low, average, and highs to see how I actually fare. And then after that, I keep a record of it like quarter by quarter, because by the next quarter, then I will update the numbers and I will see how did I do the last quarter compared to the current quarter results.
But where do you get where do you get your source of data? Like what do you base on? Is it like based on the company's disclosure, or do you have some external sources to validate those?
Mostly I use the company's resources, because I just go on like investor relations Nvidia there to actually pull out what they say, and also all their transcripts and also videos earnings. I mean, for the earnings transcript, usually I just see on whatever site that has it available instant, like could be Motley Fool, could be Seeking Alpha or whatever. They usually, whomever has the transcript up first, I'll just take the transcript and then I'll read and listen to the transcript call along the way to see what exactly is the management saying for them. Then after I listen to that already, then look at the numbers and also kind of eyeball what the competition numbers are, and then think about it before I finally do up my own projections. So the data itself is all taken from the investor pages of Nvidia. I don't usually use any outside sources or outside metrics.
Let's move on to the next one. YCX, if you want to check if those small brands, they will keep increasing revenue like Lulu, Onon, CLH, how would you carry on your research? Wow, this is a broad question.
I can't answer that. I mean, I already answered those, the ways I would look at it already. So I can't answer this more than what I've already done.
I think this one, not easy, right? Given you need to spend quite a bit of time to look at each company, understand their business model, and then form the thesis. Maybe reading other people research can serve as like a start, but you cannot skip those like your own analysis. So I think just need to invest the time if you are interested. Okay, YCX, what do you think of Tesla? Will they be able to grow revenue upward consistently, or they go downhill flat or cyclical from here and multiples collapse?
No clue, man.
No clue.
Tesla is a surprisingly very secretive company. At the same time, even they kind of operate in a model whereby because they have no marketing and because their engineers are so secretive themselves, we kind of do not know what exactly that they are doing interior, except from what Elon Musk reveals occasionally from time to time, and then what like the other sources that like Reuters and things review, and then even when they review, like we can kind of see like there's this public back and forth between like Tesla's marketing department. Marketing department is just one person, so you know who that person is,
Yeah.
saying yeah, whether if something is false, whether he denies it or not, or whether he confirms it or not. And again, the same marketing department kind of like gives dates, and you're not sure whether they keep to that date or not either. So it is a very volatile company. And yeah, if you are an investor in Tesla, you kind of have to understand that you kind of need to have that true believer in their execution, because previously, like a year or two back, when I talk about Tesla, I say that they have to execute everything perfectly in order for them to hit the valuations or the price increases that they are going to reach. So right now they are really down from that high. So there is less of that pressure on them. So to actually get back to the previous numbers that they have to get to, they don't have to execute perfectly, but they just got to keep to timelines or at least show some results for them to reach back to the prices that they are back then. So as I said also in the chat itself, is that if let's say that they are actually cutting down or delaying their plans on consumer models of EVs, right? That means the low price range of, then the next logical step would be that they would have to cut employees. So if they actually do that and cut employees, but are then still able to execute, then that would overall means that their operating margins will increase, and then that's a good thing for them. Yeah. So usually that's the case when it comes to companies abandoning products. The next stage is actually just going to be layoffs or something of that sort. Yeah, to try in an effort to cut off like the excess and then improve their margins as well. So it is a cycle. It's a cycle for that to happen. So I think Tesla's price is at the price range where this 160 to 100 to 200 range is where it should be based on and it really depends on what other news that they give out, and then whether these news are justified on the revenues on their earnings reports side. So you can kind of see that it's going to be like this because they are secretive, and this is their way of doing their work, and their investors are very sensitive towards any kind of news that they release.
Yeah, I think on marketing, they started to spend some time to learn how to do marketing. They have some budget, but they're doing it at a small scale and slowly ramping up. That's on the marketing side. But on the PR side, really, I don't expect any changes. It's just one person doing all the communications, but he's quite active. So, the Reuters news was commented like 15 minutes after it got published, right? So you can see that it is all fast moving. And if you want to follow all this news, there's only one place that you should go, which is X or formerly Twitter. So I think you get all sorts of interesting news there. That's on the news part. And then on talking about the current environment, right? I think they just reported their sales in Q1. Actually, it was lower compared to 1 year ago. And I think this is the environment that they are in right now, which is that EV sales is coming down. And this is not just Tesla, it's also true for other companies. Even BYD sales also come down, right? So it's not like just talking about, oh, there's more competition and so on. Yes, competition is always increasing, but at the same time, the entire EV market is contracting, at least for now. We don't know whether this is like short-term cyclical, or is it like it will continue to persist for the upcoming few quarters, right? This one hard to know. But the two things that is very obvious now is that sales are coming down, market is contracting, because they still need to clear their inventory. They will do some dumping on their inventory, meaning that maybe it's a good market for those who are shopping for new EVs. But in terms of the fundamentals, if you pay attention to revenue or profit, it will look quite challenging over the coming quarters and maybe upcoming few quarters. All right, that is my comment on Tesla. YCX, what data point you use to estimate for Nvidia? How come your estimate so accurate? Wow.
I look at some of it is I talk to people in like yeah, that's one. I mean, I also talk to people whom are like in the other the supplier industries. Basically,
okay.
Nvidia buys from its upstream suppliers, right? TSM, SK Hynix, Micron, Samsung. All these companies, is upstream, and one thing is to talk to their employees. The other thing would be also to more importantly would be to look at what those companies are forecasting in their own earnings reports and also in their own earnings numbers. So from there, we can kind of see, right? It's no surprise that Nvidia is doing well, because look at the orders for SK Hynix HBM3E memory. It's like suddenly there's a huge increase in it, and it's no surprise that the entire increase is 90. I'm just guessing over here, but I think it's like 70 to 90% is allocated for Nvidia. So if Nvidia is demanding so much, that means these companies are producing so much, right? So Nvidia is definitely having that kind of inventory. Then I look at the downstream, which is like I look at who Nvidia sells to. Majority is like selling to like this Dell, Lenovo, Gigabyte, all these. And again, it's the same thing. Look at their earnings and look at what they say. And then of course, we also can look at the downstream, which is like Microsoft, Oracle, Amazon, Meta, all these, to see what they, and you can kind of just see from all these things, then I don't have like a portal whereby I just aggregate all these things, and then when it comes in, I look at it. It's more of like I just, from time to time, when these reports come out, I just look at it and listen and also see their numbers, and then from there I kind of like put together like a intuitive picture of what's happening on the spot. Yeah, because there's no point for me to actually to spend so much time to get like an accurate number or figure. I just want to know what is like in the range of where is it in the range of. So then that's how I would set my price target range around that number. That's how I determine. I'm not going to be like say, oh, it's going to be exactly this number, because it doesn't make sense for me to do that. The stock market is not that it's not like this kind of, it's not like this kind of things is that accurate anyway. So there's always a chance that there's something else that's going to be affecting it happening. So to me, I just look for confirmations of like, are the sales going up? Look for confirmations, are the companies demanding more, and on either side of all these things. And then I look at like that, and then I would kind of like see that, like for example, I give that you can see that the revenue growth, right? The growth percentage over the analyst forecast. That means the analyst forecast and the company forecast, and the number of times they beat earnings, right? Can kind of see that as the numbers is getting bigger, the analyst numbers are getting more and more accurate, because it's no longer that kind of like huge beats. So we can kind of see that it's unlikely that there will be another massive beat on this coming quarter in May. The numbers, yeah lah. So I position the price targets that I look at in that kind of perspective.
Think we are still in Nvidia topics, right? I think there are what three linked one. Let me read all of them, then we see how to comment on this. YCX, can you comment on this scenario? Now there are a lot of funds raised to buy GPU for AI training. If after 2 or 3 years during the inference stage, AI did not generate the expected results, mirroring FSD keep dragging, it can work but not perfect. With that, unable to commercialize and generate revenue. A crisis happen and short of cash and cannot continue to train or inference and excess of GPU. MD, others come up with GPU. Nvidia goes back to 10 billions revenue companies. So I think these are all linked, but I let you choose which one you want to comment on the statements here. So I think there is touching on like different things here.
Okay, so the fundamental the whole premise over here will be on the second sentence, which is that AI did not generate the expected results.
Yep.
Right. Mirroring FSD keep dragging, it can work but not perfect. So the thing over here is that AI itself is a very broad field. Again, there is FSD, there is like large language models, and then there's also the things that people nowadays are not talking about that much, which is like AI recommendation systems or like the other systems that are tagging onto what the LLMs do for them. So when we talk about LLMs, right? LLMs itself, the reason why they are so talked about is because they have many use cases in it. So like the most immediate use case for it would be that it is a better Google search, because it kind of you are able to interact with the results or like ask it to summarize the results in a way that is more palatable or helps you to think through and make decisions. But there's also the other main use case, which is that it helps developers write code more efficiently and debug more efficiently, and also understand the different coding errors or coding error messages more efficiently. So in terms of generate the expected results, right? This is more of a spectrum than a 1 or 0 statement, because 1 or 0 meaning binary. So it's a spectrum because AI is already generating expected results. The question is whether it will generate more of the expected results, because from the developer space that I know, right, all the programmers, they are already reporting efficiency gains of like 40%, upwards of 40% of more, 40% of more or more efficiency gains. And that was like 6 months ago's numbers. So expecting like, let's say once like a better model, AI models, which they will come out with, like GPT-5 or something come out, these efficiency gains will go up even higher. Okay. So let's say we just take a modest estimate from a 40% efficiency gain to like a 60% efficiency gain, right? That would mean that correspondingly, the number of new hires or the number of new developers that people are going to hire is going to be much lesser. A company that originally needed like 16 developers would now probably only need like 9 to 10 developers. And that would be like all the developer salaries that are saved, right? Because they don't need to hire that many. The existing ones, they will keep. The people that they hire, they will keep, but then they will trim some along the way and they will not hire as many, because the existing ones that are very familiar with their own systems and are able to use their own AI models to write out more code, they will remain in their jobs and become like subject matter experts in those companies itself. So what we are seeing over here is that for the developer space, it's going to become a more like company specialized knowledge type of deal. It's not going to be we will have more job hopping, because the job hopping would mean that there's a longer period of learning to get the developer to the stage whereby they are able to contribute functioning or productive code to those companies itself. So my point of view over here is that AI is already generating results. It's whether the results are good enough for different people involved in it. Yeah, that's the kind of thing. It's not a matter of whether they can commercialize and generate revenue. They are already commercializing and generating revenue, which is why beyond the first wave, that 2023 wave, we are seeing these companies are still allocating more money to actually scale up, because they are scaling up now because they have the cash reserves and they are seeing a future. This management of all these companies they are buying, they are seeing a future whereby they don't have to have that many developers developing things. They don't need to have so many overheads, because with more developers, it means that you need like a HR department, you need more people you need to have more benefits, you need to have like all kinds of services that are associated with a larger company, that kind of things. They want to keep their companies at a certain size whereby they can more efficiently generate out results. So this is what will happen to the existing companies, that they are already seeing this, because to the accountant perspective, right, is these AI machines, these GPUs, right? They are essentially, you're buying this hardware is essentially buying brains. You are buying computer brains, So these computer brains are just there. And right now, the model now is that the developers will use the brains to generate out, to enhance their function and generate out results. That is what's happening right now. And the next stage of it will be that, is it that they, all these forefront of the AI things they're working at, is whether they can create like a more autonomous system whereby it is an AI model that is able to take an idea, not just like a specific request, but more of like an abstract idea stage, and then continuously generate out different results of that idea to eventually generate out like products or an outcome that people will look at and think, hey, this is the outcome that I want to or want to execute based on whatever that the AI has planned out, and maybe tweak and edit along the way, which is why what we are seeing with video generation right now, people are seeing whether they can create an entire movie out of this video generation kind of things, which is exactly this, right? There's taking an idea and letting the AI do the whole thing to see whether they can then edit along the way to make out a full product. This is what's going to happen. And in order for this to happen out well, if you try generating an image on GPT-4 now, it probably takes like 5 or 10 seconds around that to generate out the image based on what you want. And you'll spend another like minute or so to tweak it to the image that you want it to be. People that want this to be faster will need more GPUs to make it faster, and then generate out more things. So it's kind of like a scaling productivity based on the speed thing. So I mean, I've given out all the ideas that I can talk about on this generating the expected results things. Sorry if I go too fast, but these are all the thoughts that I have that is condensed into this. So as for the third part, which is that a crisis can happen and short of cash and cannot continue to train an inference. That's the thing. These companies that you are seeing right now that are buying all these GPUs, they are reporting good operating margins. They are reporting increasing margins, and they are reporting increasing revenues as well. Amazon is, Meta is, Microsoft is, they all are. So they are the ones that are buying, right? And it's kind of like the existing scenario that can happen over here will be what's similar to like these companies in the past. What they will do is that things are going well, they're going to hire more people, and they're going to hire more people, and then they're going to overhire. And then when suddenly things go bad, they start to lay off people. That's usually the case that happens. But in this case, right, this cycle itself, you can see that the hiring of more people is not really hiring that much. So we can kind of see that they are replacing their hiring with buying hardware, because is their belief that the hardware can replace the overhiring and the proliferation of like new employees that then would switch jobs or take knowledge outside of their environment.
Yeah,
that's all.
I think for those who didn't catch it, maybe you can just rewatch again this entire section. I think that's a good one. And I'll argue that actually it is even a much better model, because right now, before we have all this productivity gain, right, companies just have to hire many peoples, and there's quite a fair share of time actually is devoted to like communications, team communication within the team, from teams to teams. And once you have like smaller companies, right, or like smaller group of peoples doing more things, right, actually you can cut off those communications and become a lot more efficient, right? And they can't afford to do it in the past because you don't have all this automation tool. Now all this just become possible with the help of AI, and it will become a lot better once all these agent AI stuff become more and more common. So I think that's the good part about AI. And I also want to touch on this, talking about FSD, mirroring FSD, keep dragging. I would say that if you understand like all this AI, right, this FSD using AI, I will argue this may not be the best like use case of AI, because when it comes to FSD, actually the tolerance for error is like very thin. Like for example, you let the car drive itself, it hit someone, right? Then the liability is on who, right? We are talking about people's life here, but this is only like a relatively small use case of AI. The other stuff like what YCX mentioned, talking about all this recommender machine system, and also other sort of like generative AI services, right? Those actually, even when the machine starts to hallucinate, we are actually fine with that. We just have to, prompt it again or prompt it the better way. Then we still get the intended results after some trial and error, right? So I would say FSD, maybe if you want to try to rank, I would say is like one of the worst one when it comes to the use case. Or not the worst. I would say the more challenging part, because of the error tolerance is very low. Other areas that I think they are all doing very well. So like what Y6 just mentioned.
Okay, so the other thing I would like to say is that if you have ever used Facebook marketing, right? There's for like over the past 10 years or something, you kind of see that Facebook marketing used to be like less the targeting segments is like you can target this segment, target that segment. Like you want to target all males, you want to target males above 30, you want to target whatever. They have all these segments out there, and these segments have only grown over time. Now the segments are more precise, and like more, the range is like the gap is actually much smaller. So people are able to like just from a marketer's point of view, they can actually select exactly whom they want to market to, what geographic that they want to market to. So all this is actually AI recommender systems, because the AI is actually like getting all this data about the different user profiles, and then they are classifying them into groups, like what preferences that they have, that they like to look at what kind of news, they like to look at what kind of content, and then these are put out and then given to the marketers. So the marketers who actually use these platforms and target these particular groups that they want, they are getting better results from it as well. It's not like these systems were all in place in the past. It's actually over time we can see today, right? They actually improve it to that level of specificity already. So that is for that perspective. And then for the other thing, which is that I think that's all for that AI recommender stuff. Yeah.
Will AI make current data center REIT obsolete? Will they all need Nvidia GPUs?
Data center REITs are more of like renting out the facilities, right? So I don't think that the REITs will actually care about what the operators really do with their businesses, right? I think that's the case. I'm not sure on how the REITs are structured. I'm sure that from what I understand of the REITs is that they are just interested in renting out the facilities, and how the facilities are managed. They are usually leased out to like some data center operator which have full jurisdiction of what goes into the data center in that particular location.
So you're saying all these data center REITs, their business model is basically have the building and then rent out the space, and actually it's the tenant that operate all this center, right? And
that is my perspective on it. So if I'm mistaken on that they actually are more involved in like the choosing of the hardware or choosing of the businesses, then that would be the case. But from what I know, I don't think that data center REITs are that involved in that level of business operations. They are more involved in like just choosing the right locations for, and then like attracting the tenant. I mean, making sure that the physical location has all the right setups that would attract these data center tenants to come in to rent that place.
Yeah, that would be my guess as well. But I have to say, I also haven't really like read up all these data center REITs before, and also maybe like different geography, it could be different also because US REITs versus like Singapore REITs could be different, right? So, but never mind, we don't comment too much.
I mean,
Like without specifying which REIT now. Yeah.
One easy way to check on this would be to see whether the data center REITs have like hardware assets kind of like on their balance sheet. Most likely, these data center REITs would only have like a land or something on their balance sheet, right? It's not likely that they have like a long-term existing assets with like high depreciation. We can also see like whether they have like a depreciation and amortization numbers over there, because for hardware itself, they will usually have like a corresponding depreciation and appreciation and amortization numbers.
Okay, let's go through this. YCX, surprised you become agent as you seem quite smart. Agent, a lot of time is dealing with people and people are complicated. Just take it easy. You want to go through all this because I think it's touching on your current role as a property
Yeah,
agent.
I mean, I actually the background on this is that my father is an agent for quite a number of quite long, right? I think 20 years at this point. So I'm just I became an agent to also like help out with his business so that I can actually like better advise his clients as well, because there are many things that I cannot do if I don't have the agent license to help out on his side of the business of the things. So that's why I become an agent. And then at the same time, I think it's kind of also a pretty flexible job for me because I arrange my own timings, and of course. Yeah. Okay. Hello.
Yeah, you are back.
Okay. Yeah. My AirPods run out of battery. But yeah. So yeah, that's why I become an agent to do this. It's more flexible work for me, and also there's a consistency to it, because I don't spend all my time doing stocks as well. Stocks is kind of like a quarterly or like weekly. I look at a few news, that kind of things. Yeah.
Yep. Follow-up questions. Do you specialize in selling HDB flats and how much you charge? Any discount for the group?
I can charge. I mean, I can sell HDB flats. I'm pretty open to it as well. I know the procedures, so I'm not sure I would classify myself as specializing in HDB flats because my range is quite broad. But suffice to say, I can sell it, and I know the entire procedure of selling HDB flats, including like needing to register like the intent to sell, and then the intent to sell is for like a year, and then what is the procedure like, or the timeline like to sell? Because the number one key thing about people who are selling their HDB flats is that they want to move into another location, right? So the timeline itself, the timeline planning of all this is important, and different people have different cases, and like some people want to move in, they can direct move in. Some people need to renovate. What's their renovation timeline? All these things, and then also to find the right buyer that can conform to that timeline, and then also to seek out where's their new place that they want to look for, and also plan for that timeline. I do all that lah. So just to say that. If you are talking about specialization in that manner, yes, I do all this. Any discount for the group? I would say their prices are all competitive nowadays, and for the level of service that I do is the same number throughout. I can give like discount. All this is open to negotiation, and it's depending on what is the request and how difficult the case is. That level of talking. So if you have any that you are looking to sell or looking for like a change, just let me know. That reach out to me directly and we can discuss that way. Yeah.
Just out of curiosity, right? Like help me understand the business in terms of the breakdown, right? For example, do you focus more on new projects, selling all these new project, or is it like resale? And do you just focus on residential, or also maybe touch on some commercial properties? What's the breakdown like? Just on a rough breakdown.
Breakdown wise would be that I think 80% of what I do is rental cases.
Okay.
So majority are residential rental cases. Sales comes along. Sales is kind of like a as and when basis lah. So for new projects, I don't really do that much of it. I do keep in touch of like what are the good new projects that are available. But again, I don't do every single new project, that kind of thing. So, but if let's say people are interested to go look at it, if client requests to go look at it, or it's nearby, then I'll bring them to go see. Yeah, but for new projects, what I tend to just look at what I find is the best project for like the next 3 or 4 months, and then I will look into that project in more detail and understand it in more detail. Because there's many projects every month. Every month there's 1 or 2 new projects that come up. So it's quite difficult to actually look to specialize and look at all the projects. So as I only live in the west side, I don't really like go over to the east area as well, because in terms of like travel fees and everything is higher and takes up more time. So I focus more on like the central and the west regions. Yeah.
Any plan to, expand, let's say, leverage on social media when it comes to servicing your client, or increasing the sales? For example, like setting up some TikTok account or some YouTube account specializing all this property business.
Maybe at some point, but for now, I'm comfortable with what I'm doing right now. So it's kind of like a see how it goes basis, because I'm a very like I'm quite hands on, and I like to be more in depth. I don't like to like just spend money to like just do marketing. Then like I like to be more specific in how I do things. So it's kind of like I must be familiar with it before I actually spend money and do it. That kind of thinking. So I focus more on like getting what my clients want, and then in that regard, not in like the move on to like many sales, move on to like hit high numbers, that kind of things, because I don't think that is that I mean, there are people who specialize or are very good at doing that, but that's not what I'm comfortable with doing.
Okay, sounds good. Shout out to YCX. Anyone who want to buy, sell properties, reach out to him directly. I'm sure you see the way he does all this due diligence on companies, right? I believe on real estate also there will be same level of service. So I think this one definitely, those who want to get services, reach out to YCX. YCX, for your own personal investment, which broker do you use, and what is the rationale, and how do you secure your password to your assets?
I use IBKR mainly, and securing password is I remember my passwords. Yeah. Yeah,
do you write down?
I don't think. I mean, I key in every day, so there's no need for me to write down my passwords.
I see.
Yeah, because I already have that password being used every day. I think you want to train on like not needing to, because passwords is something that if you want to remember it, then don't ever check like the remember password thing, and don't check like remember accounts, and just key in every day, and just key in every time you need to use it, and then like after like depending on your own learning ability, like maybe after like a month or 2, you more or less remember what to do, right? And then you just key in, and then you remember your passwords. So just keep using and keep keying in. If you're lazy to do that and you just press all the remember, eventually you'll forget about it. But even then, on IBKR, I believe they have like, because it's a centralized system and they have their own customer support, you could always just And when you set up, you have your own KYC with it. So there's a corresponding email address as well. You can always email them to like reset the password. And I haven't had the need to do that. So I'm just saying that the general use case is that you can email them to reset your passwords. It will take some time and your position will be locked there or something. They'll do some verifications and stuff. And then you'll get back into your access. Yeah.
Yep, sounds good. Okay, next one. YCX, when we are buying a growth stocks, how do we know if growth is sustainable? How do we tell small dip from fat running out of steam? Any tips here?
It's the same as what I have mentioned just now. Look at its upstream and look at its downstream. Talk to the people and also look at their reports and financials. Try not to look so much at like the news. The news that we see on the like that they are fed to us, right? Either through social media or whatever platforms itself, right? They are just there to give you the takeaway from that is to give us ideas on like how to conduct our research. Right. But to actually conduct the research, we actually have to go directly to like the different companies' numbers, their platforms, and to see what are they saying, what their reports are saying, what their numbers are saying. Because if we rely on all these social media like third-party analysis to tell us what to think, then we are not getting a full picture. We are getting a picture of what the analyst or the media personality is saying regarding it. So I recall that during the January period, there was a lot of like analysts that actually say that, Fed will be cutting 5 to 6 times this year. And maybe the cut will start in like March or something. And because I actually go directly to the source, the FOMC, to listen and things, I know that was not what was being said or even conveyed, right? So there is that. It is important to actually listen to the original source and what they say, kind of things. Yeah.
Yep, sounds good. Yeah, definitely. There are too much all these narratives, right? And some are useful, some are really like more speculations and opinion, as compared to facts, right? So I do think that we all just have to do our own research and don't be, like swing too much by all these opinions of others. If you have your own opinions and then you are wrong, at least you can learn from it. But let's say if you rely on other people like storytelling and opinions and you just keep on following here and changing people's to follow also doesn't help, right? Because you don't have your independent thinking. I do really subscribe to what YCX is advocating for, which is like go to the direct source and do your own research. And if you don't do your own research, just buy ETF. I think that also works, right? It doesn't mean that all this deep research, everyone have to do it, right? There's always an easier way to do it. But if you really enjoy this kind of more hands-on kind of way of doing research, you really have to do it yourself now. So I think we come to the close of the discussion because we're already like 1 hour plus in. Any other things they want to mention before we close the session here?
Right. So I just want to mention that the future of work for like all these companies is that think of the way like how people are being onboarded into companies right now is that people hire new people to come in, and it takes like 3 to 6 months process, and it takes like mentorship with people, and it takes like giving them like simple tasks or things like that to actually get them acclimatized to the company, to actually know, and then to actually have them be in a state whereby they can contribute directly to the company. So the period of time is usually 3 to 6 months to actually get this. So the more complex or more complicated or more niche your company's area is in, the harder it is to actually find the right kind of people with the right kind of mindset and the right kind of way to contribute. So think about how much time and resource in monetary terms is actually spent on this onboarding of new people. And then when these new people, when they leave, like let's say there are some that don't fit the culture or things, they leave after 6 months, a year or 2 years like that, they take away a lot of all these proprietary information or way of doing things, and they go to another company and they may or may not implement it accordingly. But there is a lot of like this information and operating model leaked to other companies. So this is the current model that is right now, that how work is being done. The future of this work, this area that is being implemented, right? I mean, it's already being implemented in like these companies that are at the forefront of tech, is that they have their own AI model. Basically they have their own proprietary ChatGPT that is like specialized in their own company data and way of doing things, right? And the moment a new employee comes in, they just give them access to this model and then tell them to like just learn from this. If there's anything that they are not sure or whatever, aside from asking their mentors, the number one thing that they can do is that they directly learn from the AI that is built for this whatever company's model it is. And when they learn in this way, they learn very quickly how the company works, because there's no need to actually like do that trial and error stage whereby they try something and they realize that this way of doing things is not what that company is used to, and it's actually some other way. There's actually like terms to reference, or like companies' organizational structures to know that kind of things, who to report to, what to do in whatever emergency kind of cases. All this the AI can answer first and give like this first level before, and then these new employees can actually then do accordingly, or actually seek a guidance, know exactly who to seek the correct guidance from to get to the issues that they are facing. And then they are able to contribute in better productivity in this particular way. So this is how, from my point of view, the future of work will move towards to this level. So every company will have their own AI of some sort, if they are to actually help in doing this kind of work.
Yeah, basically everyone have to build their own chip Nemo, right? The one that built by Nvidia.
Yeah, basically the first thing that would happen would be the retrieval augmented generation that most companies are going to build up, because it's a easy enough way to do, and it's kind of like the entry level drug. Once they get to it and they find that it's useful, then they think of how they want to scale up to make it faster, to include even more company documents into it. So it will happen in an organic process whereby certain segments of the company that is not accustomed to this way of doing work, they will try it out, and then they find that it reports better results, and then they will start to implement it on a company-wide perspective from that department level perspective.
Sounds good. Looking forward to that future. Hope that companies are spending more time building this. It's not just like restricted to the big tech only. Everyone have to invest on all this stuff. All right. Thank you so much to YCX for all the sharing. Really enjoyed listening to you sharing all these insights. I think we'll end the session here, and let's chat again next time when we have all this.
Thank you.
Thank you so much.
Thank you. Bye-bye.
Bye-bye.